It's Bob Anderson from Factory Direct Modulars, and I wanted to do a quick video because I've had some observations in the last week or so, a little over a week or so, that have all hit me about the same time. I was cooking dinner tonight. I just got done feeding Cookie, and I'm not around my phone, not being distracted, and all of a sudden I started going, oh. I started putting all these pieces together of the things that have been going on lately that are a little disconcerting. So, let me step back for a second. Some of you may remember I've said in the past that I used to be in the mortgage business. I used to also be a certified underwriter in the mortgage business, but I also originated loans, handled about 3,000 families' personal loans to get their first-time home buyers. So I know a lot about lending, and like I said, I used to underwrite loans too. I was certified to approve loans up to $1 million back in the day. Back when $1 million meant something. You go, Joe. Anyways, so let's talk about the observation that I just had. I've had in just the past couple weeks dealing with different customers. I've had two that were dealing with the largest credit union in the state of North Carolina, who has announced that they are canceling any construction loans for new construction. And then, wait, what do you mean? No more construction loans for new construction? So this hit me during the week. So this was last week, so I had to kind of switch them around to some other lenders. And then a large regional lender that I do quite a bit of my government stuff with, USDA, FHA, that kind of stuff. They came out with a policy that they won't close a construction loan unless I have confirmation straight from the factory that the house is going to be released from the factory within 60 days of the closing date. So some of you may be like, oh, okay, well, that's good. Yeah, well, let me just point out where the problem comes in. If you contract to buy a piece of land, okay, and I'm going to be putting a house on that piece of land, it's the land and the home together that the lender's making the decision off of to loan you the money at the most reasonable terms. It's not, but you can't do the whole thing if the house is going to take 6 to 8 months to come out of the factory, but the land seller is not going to sit around for 6 to 7 months to get paid. So that announcement came out of left field, and then I had another transaction at a regional lender that just I think it was Monday, told the customer after I wrote the contract and rewrote the contract the way they wanted it. Long story there. Send it in. The lender came back and told the customer, it was either Monday or Tuesday. Sorry, we're no longer doing construction loans. We just found out. So I bring that up because it's like, what's going on? What's going on? The housing crisis we had in 2008 was because we had speculators buying houses left and right, and they weren't verifying incomes and whatnot, and they were it was just craziness going on back then. Loans that didn't make any sense and whatnot. What's the difference between then and now? Well, the difference between then and now is people's incomes are being verified, jobs are being verified, credit has to be of a higher quality, down payments tend to be higher than before. So there's a little more skin in the game, and they're people that are actually buying primary residences. Why is there such a rush right now? Well, because there's a housing shortage, which is different than the glut of houses we had in 2008. So I'm concerned, but I have a thought here too as to what's really going on. But I'll get to that at the end. Then just this past week, I've had 2 transactions with one lender that we're getting ready to go to close. And all of a sudden, the automated underwriting system that's called DU, it's Desktop Underwriter. That's what DU stands for. It's from Fannie Mae. And Fannie Mae's DU was kicking out the deals as approved ineligible. Well, at first, the bank, the whole bank thought there was a glitch in the DU. And I could understand that. So they were like, oh, we got to get with Fannie Mae and figure out, because they did some updates in their system. We got to get with Fannie Mae and figure out what was the glitch so that we can get that tweaked and then we'd close. Because the deals were coming out as approved ineligible. Now let me explain what approved ineligible means. Approved means credit-wise, debt ratio-wise, stuff like that. The customer qualifies. Ineligible means that the way you presented the product, the way you presented the loan, this is how it's meant traditionally. Ineligible meant traditionally that the way you presented it is not in compliance. There's a compliance issue. So let me give you a perfect example. On an FHA deal, if since it's 96.5% loan to value, 3.5% down. If you put the deal in there by accident, a $100,000 deal, base loan of $97,000 instead of 96.5, and the customer has good credit and all that stuff, it'll come out as approved ineligible. The ineligible part is the fact that you have the loan to value in there wrong. You need the customer bring in an extra $500 to make the transaction eligible for insurance. That's what traditionally ineligible means. Well, this lender, because they know I used to be an underwriter, okay, and these are my customers, they sent me the DUs to read also. So I'm sitting there reading the DUs because I was looking for the bug. I was looking for the twitch. I was reading through the transcript of information from DU to try to help the underwriter and try to help the bank debug it and get the loan closed. I couldn't figure it out. So I called the lender back and I said, here, just for shits and giggles, take this transaction and do this tweak to it and tell me if it comes back approved eligible. So they tweaked it and it didn't, came back ineligible. I said, okay, now tweak this now. And they tweaked that. Long story short, boom, came back approved eligible. So now all of a sudden it could close. But I didn't debug anything. That was the problem. I had to, okay, I said, okay, guys, I get y'all excited that the loan can close, but we haven't solved the problem. And they're like, what do you mean? I said, I didn't debug anything. All I did was change the terms of the transaction. I didn't debug nothing. So this, all of a sudden, the second one happened today. Second one, supposed to close tomorrow. And they call me and they're like, oh my gosh, we got another one that's approved ineligible. We're trying to go to closing. The underwriter completely missed it. A week ago, the underwriter signed off on the file. They sent the file to closing. It's a closing person actually figured out that the file was approved ineligible. It wasn't the underwriter. The underwriter didn't even see it. So anyways, what I ended up determining from going back and forth with this bank multiple times in the past week over these situations is that DU, which is Fannie Mae, behind the scenes, has changed their requirements without publicizing it on who qualifies for a construction to perm loan. Because if you took each one of those customers and you ticked off credit score requirement, yes. Debt ratio, yes. Reserves, yes. If you can check off all the boxes that it met the minimum requirements, if not more, on every box, and we're still getting ineligibles. So I bring that up because even Fannie Mae's getting nervous. Fannie Mae's getting nervous. Now, let me bring something up as to what I believe is really going on. Okay? These loans, these construction to perm loans, they have a lifespan on them that they have to be delivered from the bank to Fannie Mae for insurance. And if they don't hit that timeline, it's like the file starts all over again. Okay? And that timeline's about a year. And what's happening is builders aren't getting their homes done in a year. And these banks are getting stuck with loans. That's what's happening. And Fannie Mae's getting kickback. I'm telling you. So what they're doing is they're behind the scenes, they're raising their standards, or in some cases, some of these banks are just saying, forget it. We're not even doing it because it's too risky. And I get it. It's very sad. One of the other risks that these banks take, for example, this national lender that had these DU problems, I happen to know one of the large construction companies that they do construction perms for in the Mid-Atlantic. These $400,000, $500,000, $600,000 houses. And I just happened to ask about 2 weeks ago, how many of those do you guys still have in your books from last year? And they were like, every single one of them. Not one of them's been done. They're all at like 70%, 80% done. And I said, you guys do realize, that you closed those loans at say 4%. That's a hedge rate a year ago. And the current market rates are over 5, right? They're like, yeah. I said, so if and when that house gets done, and you have to sell that loan to Fannie Mae at a 5% rate, but it only has a 4% rate to it, and it's a $400,000 house, that you'll probably lose $12,000, probably about 3 points. You'll probably lose $12,000 just selling that loan on Wall Street. Remember, guys, I used to sell loans on Wall Street. And they're like, yeah, we know. So see, the other issue that these banks are facing is because these rates are going like this, they don't know when it's going to stop. They don't see any leadership in Washington to try to address this. And they're getting freaking nervous. See, a recession could sometimes be a self-fulfilling prophecy, because you could talk yourself into a recession if you allow yourself to. Anyways, one more thing. I know a real estate agent who was a former CPA also. So he got a little nougat on his noggin when it comes time to understanding numbers. And he calls me about once every month or so just to BS and see how my business is doing and whatnot, just to talk shop. And he called me just a couple days ago, and he was just wired to the moor. He was like, this is ridiculous. He was talking about, he's out of Charlotte, and he does a lot of real estate development, big projects. I'm talking millions and millions of dollars in projects this guy does. He's very intelligent, very well spoken. Anyways, he was telling me that they have now projected all of their 6,000 square foot houses down in the Charlotte area are now going to take 16 months to build. 16 months. 16 months. These lenders that are out here doing these construction loans, They don't want 16-month projects. They don't want 16 months projects. So anyways, it's just another noose around the neck that, creates another hurdle that we got to deal with on a day-to-day basis here at Factory Direct Modulars while we fight to try to keep your costs down for you to transact business with us. And I tell these stories because it shows that at least the leadership here is aware of these things. And I try to circumvent them and deal with them. And I certainly have a lot of contacts in this industry to help fix problems. I want to leave it at that, and I will talk to you guys later. Have a good day.